All right. Hello, everybody, and welcome to another Pepperstone live stream here on YouTube. We hope you're ready for a very exciting session today. We're going to be covering everything to do with some basic day trading strategies and obviously going through the market as well as we're seeing it at the moment. So it's going to be really, really good. My name's Thomas Atkinson. I'm always as joined by Tyrone Abela. How you going, Tyrone?
Good, thank you, Thomas. Hello, everyone, and welcome to tonight's edition. Yeah, we're going to look at scalping, probably a timely reminder of what you can actually achieve in markets that are very, very volatile at the moment, obviously for all sorts of reasons. We've got a lot of volatility in the market. So scalping and day trading, they can be certainly used together to actually take advantage of markets like this. I'm looking forward to getting into some strategies that can describe that for you.
Yeah, I'm always excited to talk about whether it's beginner strategies to intermediate to advanced. You can always take something really, really great out of these types of things. So let's just quickly talk about what we're going to be covering today. Now, one of the things that we're going to be looking at is managing risk during volatility, understanding position sizing, charting and technical analysis, and of course, a live Q&A. So if you have any questions, please feel free to ask those throughout, and we'll have a whole bunch of people obviously viewing them and answering them as it goes live. Now, we often get asked the question, Ty, I'm getting into trading. I'm interested in trading currency, or I'm interested in trading indices. What are some of the ones that we want to start with? Now, obviously, at the moment, it's all been about commodities. So people have been incredibly interested in stuff like gold, obviously silver. The stories overnight been nickel, of course, but maybe nickel's not always the best one. That's definitely a squeeze there. And there's just so many different opportunities. So oil and commodities in general have been the talk of the town for the last 2 weeks in trading. What are your thoughts? Is that a good place for people to start? Often gold is, isn't it?
Gold can be. I wouldn't be probably recommending it as your first point of call right now because of the moves that it's done. It would have been almost impossible to get hold of recently. But, had you been trading it, though, over the last few weeks, absolutely you would have been able to take advantage of this rally, really. And we've been talking about gold being long, since December, really. But it really comes down to, we're obviously going to talk about scalping tonight. Now, for beginners, when you're trading something that's like an out of control train right now, that gold is, same as oil, if you like, very, very difficult. Probably not the place you want to be starting in a very volatile market. But in a market that's moving or behaving itself, if you like, it can be very, very technical and very easy to trade with some of the strategies that we're going to talk about tonight.
All right. So, I think gold is one of those interesting ones. Obviously, majors. Liquidity is really where you want to go. So you want to go to positions that have a lot of trade on them and that have a lot of technical analysis ability. And that often comes hand in hand with liquidity. So today we're going to be going through a bit of a 30-minute to 1 hour kind of before market, strategy that some people use. And we'll be targeting, obviously, some pairs for that session. So if you're somebody that trades, let's call it the Asian session, you might want to start targeting in things like odd pairs, Japanese yen pairs, those kind of ones, or even gold. They tend to move over those periods. It makes sense, yeah? That's when the market's open. If you're somebody that wants to be trading, let's say the London Open, what might you do? Or the European session, you might want to be looking at pound or euro pairs. It makes a lot of sense. And of course, when the London session turns into the New York session, what could you be focused on? US dollar major pairs. They tend to move a lot. So when we understand what type of trader we want to be, we also want to understand where the majority of the trades come in. And in general, it's true, isn't it, Tyrone, that when markets open, there is a liquidity spike. There is a volume spike that comes in at this point. And I think sometimes even beginners don't really think about that. Of course, it's common sense. But sometimes people don't think, well, if I trade the open, will I get larger moves? Will I have a better potential here for day trading? And I think with scalping, you do.
You do. And look, the problem, one of the biggest misconceptions is not understanding when markets are actually opening doesn't really matter. It matters a lot, especially if you're scalping. Understanding exactly when a market is going to open and for which particular pair it's going to be most relevant to is a very, very important thing to remember, even as a beginner, because that gives you an insight as to where the spike's going to come from. Like, is the Mexican peso going to spike at the opening of the Asian session? Probably not. But is the US dollar yen and the Aussie USD going to see some action when their real market's actually opening? Very, very different story. So understanding which open and when and which currency pair is going to be most affected is a very, very big advantage, because it puts the odds straight away in your favor that there's going to be enough liquidity to actually play out and give you a move of some significance that's actually going to get you where you want to be, whether it's actually short or long.
So I'll be sharing with you a basic strategy today, but one that I've used and Tyrone's used quite effectively throughout our knowledge in markets. And of course, it's based on price action, isn't it, Ty? I mean, we love
Yeah.
price action here, and we do think that it's one of the cornerstones of being successful. We'll take our heads off the screen there for a second so you can see this slide a little bit better. So obviously understanding up markets or bullish markets and understanding down markets or bearish markets is very important. How can we do so? Well, one of the ways is we can kind of recognize what we call the beginning of any trend, which is obviously the lightning bolt. This is certainly a great concept. Effectively, it's where a market moves up in a direction. It then takes, let's say, 2 steps forward, 1 step back, and then starts to move forward. And as it goes through, let's call it the previous peak, we tend to see some follow through action here. Basically, what the market's telling us is that it's convinced, because it's had that pullback, it's had that breather, it's convinced of the next move. So a lot of beginner traders, they don't condition themselves to think about this way. Tyrone, when indicators, because of course, most people start off, we add in stochastic, we add in RSI, we add in ATR or volume or any of these other great indicators, and no doubt they are good. What tends to happen when a market moves up is it tends to become overbought. So if you have an oscillator, it tends to go into that overbought period when we hit that peak. The market then comes down and then resets effectively this oscillator or indicator for the next move up, doesn't it? So that's actually how it's working. So really the price action is showing you what happens on the indicator itself. And when you start to know the markets enough, I've found that you almost don't even need the indicators on the chart because they'll always be doing something very similar at the same time, won't they?
Yeah, exactly right. And the more clean that you can keep your charts, the better it's going to be. Look, one thing about being a beginner, and I'm assuming a lot of people in here are just starting to start their journey, or maybe they've only just been trading for a little while. People make the mistake of thinking that the basic strategies don't actually work. Like you might be thinking to yourself, well, yeah, these guys are only going to teach us, basic beginner strategies. And, when we get better, we're going to be able to trade really advanced strategies. Actually, nothing could be further from the truth. What you're actually learning here tonight, it's a simplified method, but make no mistake, we use it every day. And we're obviously professional traders. We use this system and these setups all the time. Okay, so just because we're teaching them at a beginning level, don't think for a second that they're not very powerful, because they are the cornerstone. Like Tom said, higher highs, higher lows, lower highs, lower lows are the cornerstone of any momentum trade, be it a scalp, intraday, day trade, even longer term. So the strategy that we talk about now is what we use all the time as one of our key things. As you get more advanced in trading, you're going to learn different techniques that can actually aid you to find different sorts of trades, different sorts of markets. But in essence, what you'll see in the scalping that we're going to talk about today, you can use in everyday life, and a lot of professionals use it very, very successfully.
Exactly, Ty. It doesn't matter. I had people today tell me, I understand the market. Dangerous words. I've said that to you before, haven't I? I said, I am the king of the world. In fact, at the moment, I feel quite kingly. But that doesn't mean, what you've got to do is you've got to bring yourself back down, and you've got to say, okay, I might think I understand the markets, but as soon as you believe you understand something, it's probably because you're being slightly naive. We constantly are improving and learning and always strategizing. I heard, Druckenmiller, obviously, Ty, very, very influential investor, massive, possibly the best investor of all time. He was talking in recent interviews in the last couple of years. He was saying, when I began trading, it was totally different to how it is now. And I've constantly had to evolve and adapt my systems with the different time. And if I had some of the tools that now are available to us as retail traders, my edge would have been so far and beyond even the street's edge back in the 70s, 80s, and 90s. So it's amazing when we consider how much information we have, but also that we need to remain humble. And I think that's what always seems to be a big thing. Discipline, humbleness, big deal.
100%. And look, even from the standpoint of, talking about the simple strategies, when we are putting together our videos for our community, for the most part, we're actually talking about things that are coming straight out of our course. We're not just creating things out of nowhere. And even if you do, as an example, the Tuesday watch trade, let's actually display the Tuesday watch trade that we did this week, Tom, just to give people a bit of an example of what we're looking at, how simple trading can actually be by applying the exact same. Can we go to a 4 hour for a moment? You want to
step us through this? Yep.
Yeah, 4 hour on the euro.
Yep, 4 hour.
All right. So Look, Tuesday Wrap is a video that we do every Tuesday for our community, where I look for the best trade that I can see, a trade only that I would participate in if it actually played out, and I would actually play it out, put a video in, show exactly where we trade it and how, and let it run. So this one in particular, we know the euro has been in basic free for all. Okay, so we're looking at the low, high, lower, low sequences, and we know that's, well, obviously we're in a downtrend. But what we also know, and this is again at a very beginner level, that the 20 moving average is one of the most important moving averages that you're going to find in any time frame. The bigger the time frame, the more important the moving average. Now, what I noticed yesterday when I was doing the video was we were getting all of that consolidation down at the very bottom, and we could see that it was wanting to actually try and break up. You could see that the prices were reversing. When we go to a smaller time frame, you're going to see a series of higher highs and higher lows, just like we described earlier in the slide. Now, the obvious target, this is where people get it wrong. And this is where, even from a beginner's standpoint, you can absolutely lock in the target that you think it's going to go to, purely because that's where the stats say it is. This is the 20 moving average. It's a very, very clear target to aim for when, one, we're in a downtrend, two, we haven't touched it in quite a while. So that is your, guess what? That's your take profit. So when you're entering in at about, I think the trade got in at about 109.20 or 109.21 on the smaller time frames. We had a higher high, higher low sequence on a 15-minute chart. Boom. Off it went, and pretty much hit the target. And it's up there now again, trying to test this target again. But the point is, you're well and truly out of this trade by now. Okay, that happened, well back yesterday. You can see the high, low sequences on the chart, and bang, off it went. Really, really basic 101 trading. You don't have to be a trading genius to know that. You just need to know and understand where a trade is likely to go to, and use the key concept of the higher high, higher low for a long position to actually enter the trade. It is truly basic 101. And I'm not just pulling out one example. You can go through our last 5 Tuesday Market Watch videos, and nearly all of them are based on the exact same thing. There is nothing there that is new, or something that we're leaving on the table. We trade quite often in a very, very basic way, because guess what? It's the basic and the standard that actually works. And in the end, it doesn't matter how many indicators you've got on a chart. It's really understanding price action. And like Tom said earlier, the more you understand of how price is likely to play out, the better a trader you're going to be.
Look, Tyrone, you hit it nail on the head there. Not only do we love very basic stuff because it works, but really, what is price action? And this is a great one that came out today. And I want to bring in the concept of head and shoulders, which is a concept that a lot of people discuss. But somebody said, hey, do these fail a lot? And was in context of the index. So in context of the S&P 500, ASX 200, etc. Very interesting point. We'll get back to that. So Tyrone, one of the things that we talked about before was higher highs and higher lows. Well, what in essence has been happening here on this 15-minute chart is that if we had recognized this trend, which as you correctly was talking about, we hit the 20. Remember, that's where we hit the 20. Each time we've come back down from that, we seem to be holding this pretty good trend line. If you were coming into a session open, like we did today, only a few hours ago, and you were sitting on that trend line, which you could have drawn, this is a good trend line. I mean, you can see here a series of higher lows, very good. And you're coming into a session open. Wouldn't that be a fantastic place for us to be looking towards actually both the long and the short? Remember, we're not biased as traders. We might have a bit of an idea of where we think it's going, but in general, we're looking for the clues. And one of the clues that we've talked about before has been rejection wicks. Just like over here at Tyrone's 20 moving average, it hit the profit. But not only did it hit the profit on this smaller time frame, what happened? It rejected. It sold off. It sold off. It sold off 3 times. It sold off with wicks, meaning that there were sellers and the buyers were less committed. Remember that really it's a dynamic between the buyers and the sellers that we're looking for. As beginners, this is what we need to understand. Over here at our little trend line up, what's happening? We've got a huge amount of buying wicks. We've got nice little bullish pin bar or hammer, which is a candle I want to talk about today. Very beginner level candle, but a great one. And we continue to see buying wicks at that price coming into the session open. And if you're interested in adding session opens and you're using Pepperstone with TradingView, you can actually load up here this little tag, and it says sessions Asia, London, New York. And I think I would probably put that on your charts and then obviously select it for the correct time frame. This is for GMT. And what it will do is it will put colors on your chart. for the time frames when they're coming in. So if you're not sure when, let's say, London opens, or which is 8 a.m. London time, obviously UK time, or when Frankfurt opens, or any of these things, if you don't know, that can be a good guide. Usually you can kind of tell with the volume, because the volume will start to spike up. But what a great little zone here for the session trade today. Pretty good, yeah, Ty?
Oh, 100%. And if I was doing my Tuesday market watch, right at that time, you can bet your bottom dollar that would have been the Tuesday market watch trade I would have tipped, because it's very, very logical where it's going to go if it breaks to a new high. And it's also a part of, and playing a part of, a very, very important trend line. And that is really trading 101. Now, does that mean that you're going to make less profit? Because trading 101, absolutely not. Profit is profit. And keeping your stop losses and take profits in check is part of the key to actually be successful. It doesn't matter how simple the trade is. It's all about risk management and identifying the good opportunities. Advanced traders become better at understanding these opportunities and locating them. That's the difference between a beginning trader and an advanced trader in our community, that the advanced traders are actually able to identify opportunities quicker, more often, and actually make less mistakes doing it. That's the difference. They're really setting up the same trades. God honest truth. They really are. Because I know this because we do it.
So, Ty, we mentioned the 20 moving average, and that's obviously going to be relative to the time frame that we're on. So if we're like a scalper, I mean, that was a great little just trend line, absolutely great. But we've now got an interesting point where we've breached that 4 hour. And I just wanted to bring up, firstly, one of the things that we know usually is respected, and that's especially the daily 20. So the daily 20 sitting here, we've got a huge price gap between this. This is obviously due to things like the tensions, obviously, in Russia and the Ukraine and everything going on there. Plus, people are fleeing the euro at the moment and going into safe havens, the CHF, the Swiss franc. You do need to understand the major currencies. I'll talk to you about that very, very soon. But we're pretty far away from this daily 20. Now, if we go down to the 4 hour, we're putting pressure on your very level here, Ty. The first time was a good touch for rejection, but now we're putting pressure back on there. If we breach through this zone, although it's counterintuitive to the current trend, which sometimes, we don't prefer to do that, but sometimes you do have to do that. If it breaches through this zone and then retests back down on this level here, and we see the lightning bolt, which we were talking about before, let's say on a 5-minute or a 15-minute, could that be a fantastic trade for investors and traders out there? Is that something that you look for?
Yeah, especially in a market, what we definitely want here is very, very important to look at the time frame that we're trading here, which is a 4 hour, and the close that Thomas is referring to is the close on a serious time frame like the 4 hour. Don't go to a 1-minute chart and see a close above that level and say, yeah, let's go. That's just not how we operate. It has to be. Don't forget. Remember, the bigger the time frame, the more important the close. Okay, so. And that stands to reason, because more people, obviously, around the world are actually watching the market at that time and having their say as to whether it's going to close up or whether it's going to close down. Very, very straightforward. So the bigger the time frame, the more people looking at it. And this is why the daily is so important, because the daily gives every market open an opportunity to participate in the direction of that particular currency pair or indice or commodity, whatever it is that you're trading. Every single open and every single session has a say in direction of whatever you're looking at. That's why the daily is such an important close.
So the daily closes above, all of a sudden we get a whole bunch of opportunity. Now, obviously, we are meant to be talking a little bit here about understanding position sizing, understanding risk. So let's say you're using here the TradingView platform and we wanted to put in a long position. Let's say the market does what we suspect and it does this. If we then go over here and select long position, you could actually, theoretically, depending on where your entry was, so let's say it was here, you could figure out, and again, the reason we like the lightning bolt so much is if you have a lightning bolt and it starts to break through, we have very clear stop loss levels. Stop loss underneath here or stop loss underneath here. What that will give us is it will give us a level or a zone for us to be basically knowing that if it comes back under there, it's probably going to be a failed trade. By being patient and waiting for this scalp and waiting for the pullback, because remember, most retail traders, most beginner traders lose because they take breakout trades, Tyrone. This breakout trades tend to be the ones that stuff up the most. It's actually the conservative pullback, the harder thing to do, being patient.
Exactly.
That's the harder thing to do. And here we might have a little scalp where we take it up to possibly up here. It's quite a large scalp, or we might just take it up to the previous highs. But we can at least figure out using this tool where our stops might be. So we could say, okay, entry here, stop loss, let's say below this low by a little bit extra, and it will give you a ratio. And that ratio will become very important. In this case, it would be a 2 ratio if that was what was happening. So limiting our risk is very important in trading.
Yeah. Remember that breakout sounds like fake out, and fake out is what brings everybody undone.
That's true.
Very,
breakout
very
sounds
important.
like fake out. I don't like that.
Yeah.
I've been faked out a few times. I can say that.
We all have. Everybody has. And don't ever feel bad about it, because it's going to happen to you at some point. But remember that the bigger the time frame that you're looking at, the less chance that you're going to get a fake out. And this is why we always look at the bigger time frames first.
So a lot of people will come in and they'll learn the essence of patterns. Now, obviously, patterns is in our course. We do like patterns, but it's more than just thinking about the pattern. I know this is a beginner, but if we understand, let's say, the essence of a head and shoulders, and I want to bring this up. So what a head and shoulders really is it looks like this. So effectively, it's price and it's a series of lightning bolts. Effectively, what's usually happening into a head and shoulders is something like this. Some form of downtrending market that then makes an extreme low, the head in this case, then it comes back up, forms a neckline, which in this case is, of course, the neckline as we call it, or the resistance, and then it pulls back, getting ready for the next move. So in essence, what is this? Well, it's actually a lightning bolt, a trough, a peak, a higher trough, and a higher peak. So it's just a change of trend. That's all this pattern is. So it's not about thinking about it as a pattern. Every pattern is pretty much just some form of changing trend or changing dynamic in the markets. But what we're looking for here is we're looking usually, and the reason why people love patterns so much is they get a predictive amount of where something will go. Now, if you're going to be a day trader and a scalper, this is a good question for you. Will you usually use patterns as much? And I think the answer is you can use patterns, but you will be more predictive to where your take profits and stop losses are going to be, etc., based on the price action itself, based on where you think the next key level is going to be. So a lot of people end up trying to say, okay, well, what's my statistics on a head and shoulders pattern? Now, in currency pricing or in currency, whether it's a head and shoulders positive or a head and shoulders negative, they probably have very similar statistics in terms of working out. Let's call it in the 60s by themselves, not with the extra additionals that you can bring together. But if you're thinking about the stock market and you're trading the S&P 500 with Pepperstone, do we think, and I'm going to ask the chat this, which one is more likely to be successful? The inverse head and shoulders, the one that's coming off a downtrend into a bull trend, or the head and shoulders, the one that's starting from an uptrend to a downtrend? Once they break through here, which one is more likely to be the breakout versus the fake out? It's a little bit advanced, but you've just got to think about it logically. I'll give you a few seconds to answer it. So let's see if anybody in the room can get this right. In a stock market setting where we're trading a stock, or we're trading, of course, the indices, so S&P 500, NASDAQ, whatever your favorite is, which one's going to be more likely to be successful?
And the other thing that you mentioned there, Thomas, which is really, really important, the success of the head and shoulders and the inverse head and shoulders, a lot of the time actually comes down to people screwing it up, to be truthful. Like a lot of people actually completely screw it up, and then they say, oh my God, the head and shoulders pattern is crap. It doesn't work. Yeah, you screwed it up, mate. You haven't actually traded it right.
I've seen some really bad head and shoulders. Let's just say if you saw them walking down the street, you'd be like, whoa. Yeah. Are you from outer space? Yeah. Welcome to our planet. Welcome.
Do you really know what a head and shoulders is? Man, like you've got to understand that you have to wait. Confirmation is key. If we can pass on, I know this is a beginner's webinar and we're really trying to pass on as much beginner knowledge as possible to really help you advance to the next level. But if you can take one piece of information from us that we promise you will help you and serve you well into the future as traders, it's patience. waiting for that close, because the majority of people screw up a head and shoulders or an inverse head and shoulders by simply not waiting for the breakout to happen of the neckline. If you are trading it before you get a significant close outside the neckline, you are not trading that head and shoulders correctly. Absolutely not. Okay. Patience is the thing that will actually keep you out of trouble, but also get you into the quality trades. Okay. And although it's something that, beginning traders will probably struggle with at the start, if you can bring that into your trading repertoire, you are going to advance in leaps and bounds. Yeah, that we can promise you, because patience is key to trading, no matter how good you are at it.
So the answer, Ty, is the inverse head and shoulders for that market. And this is, again, it's actually a beginner concept. When you're trading Forex, it is a fluid currency with no real fair value. I mean, obviously we're trying to figure out what the fair value is, but it'll go up and down, and it can go up and down. It's completely fluid in price. A stock like a S&P 500 index, that is most likely geared towards the bull side. So when it comes to recognizing inverse head and shoulders, as in the ones that are down here, in essence, what you're actually looking at with one of these, let me just clean it up, is a change of trend after some form of correction, which usually is accompanied by volume accumulation base and, of course, big fund investing. So it's a totally different ballpark. And of course, you need to understand the instrument. And Tyrone mentioned before, we were talking about commodities. Right now, the hot thing, obviously the hot thing to scalp, to day trade, all of those things. But it's not necessarily going to be consistent, because one of the things that we're meant to be saying here today is, what about position sizing and volatility? Well, of course, gold and oil are incredibly volatile. And if you're putting on a position, and a trade should be an entry, a stop loss, and a take profit, if you don't have the stop loss or the take profit set when you get into a trade like oil and gold, especially as a beginner, things can get out of control very fast. You start moving your stop loss backwards, you start sweating, you start stressing out, and all of a sudden the market moves 8 or 9% against you like this, because it's really in that huge push at the moment. Let's actually put in something like US oil here, Ty. We'll actually go back over and we'll just show everybody that's not aware. I'm sure most of you are. But if you have a look here at US oil, look at what it's doing right now. So obviously it's hit this resistance a few times. It's struggling. But still, predicting this right now is going to be tough. And if you're scalping it, you must have proper risk management. Very important.
Absolutely. Very, very important. Now, I know a lot of you are out there asking, oh my God, why are you guys talking about stock when, we can't get stock on the Pepperstone platform? TradingView hasn't got that. CFDs, everyone, is effectively the stock model of whatever it is you're trading. So if you're trading the CFD version, although you're not going to capture the same dividends and franking and things like that of owning the stock outright, the CFD mimics the stock exactly and shares the same price. Okay, so don't think for a second that you can't actually trade stock. It's just trading it in a different way. You're using CFDs, which is contracts for difference, which is actually the way that you can actually trade the majority of the stock market. Pepperstone's got an extensive range. A lot of the US stocks, all of the majors, Australian markets getting bigger and bigger. So don't be afraid to delve into technicals, because people think they have to trade a different type of technical for BHP or say CBA or Amazon versus the Euro USD. Technicals are technicals. And that's what you'll learn when you start doing technical analysis properly, that a chart's a chart and price action is price action. This is why it's so important that you learn price action, because it basically translates to everything that you're going to trade, regardless of the instrument. Okay, so CFDs are the stock version for Pepperstone, and they work exactly the same way that the stock does, minus the dividend, but they're going to share the same move. Okay, so that build up that Thomas is talking about on inverse head and shoulders is going to play out exactly the same way on the BHP stock as it's going to be on the CFD BHP version.
So far we've covered a little bit of price action. We've talked about this idea of the lightning bolt, the peak, the trough, the higher peak. Obviously, it's, you could see it as being a little bit more advanced, but let's just go back to some candle stuff. So really, I want to cover a few basic concepts here. One of them, the lightning bolt. If you can learn that, if you can recognize change of trend, very important. We've seen also a trend line that's appeared in this Euro US dollar just a few hours ago. In fact, there's the lightning bolt playing out right now, the explosive action here off the break. But look, here we have very nice trend line. That can be something that we can bring in. If we recognize a legitimate trend line, that is a trend line that actually makes sense. Don't just draw lines anywhere for a reason. That's what happens. You get that messy line that's like this, and you come in and then someone's like, there's a line, here's a line, here's a line. If your chart looks like that, it gets a bit scary. But when I was beginning, Ty, and when I was starting, I kind of wish in some ways, I mean, the trend line is great. But for me, it's all about horizontal support resistance, supply demand kind of areas. If you can recognize these kind of key zones, you'll generally be more correct with your initial assessment. And if you're ever wondering, oh, well, I wonder if I've got my right levels correctly, there are actually some extra indicators then you can put in, such as volume profiles. So you can select a volume profile here, and it will actually show you some of the key kind of price action based levels where all the trading's going on. So you can maybe then have, all right, I know this point here is a key point. If it breaches here, maybe I want to get a scalp in, etc. This is another good one. And notice the key of this is, see what this volume profile is showing us. It's showing us that there's very little support or resistance in this block here. Notice how it's quite small. So it's a bit of an advanced one again, but really what this is showing us is that there's a free area. And when you're beginning, you're really wanting to understand where the participation zones are, where the support resistance is, and just kind of looking for the price to move through. That's really what the tape reading was back in the day anyway. When people were looking at prices, they were waiting for a price to get broken, e.g. a round number, let's say 100. And when it got broken, it started to run to 101 or 102 fairly quickly, didn't it, Ty? Because for the first time, people started piling into it. It's that FOMO effect.
The technical word for that, which is something that we've basically coined at FX Evolution, is I call it blue sky. Thomas calls it green sky.
Green sky.
I haven't worked out why, but he calls it green sky. But blue sky ahead is what we're looking for when we're going along, right? We want as little resistance, as little problems in front of us as possible between where we're entering and, of course, our take profit target. Now, the volume profile there is a beautiful example of an area that hasn't got a lot in front of it. And you can see as the volume increases, so will the resistance. And you can match up your resistance there. Another common problem you're going to find with trend lines, just like Thomas said, they're very, very subjective. So if you think people screw up head and shoulders, you should see them screw up trend lines. Trend lines are a problem because they can be subjective. A good trend line is awesome when you've got validation, and that's the sort of thing that you'll learn in the courses, of course. But if you are a little bit misled by what a trend line actually looks like, the good thing about horizontal support and resistance is it's very, very difficult to screw up, to be truthful, because there's no subjectivity there. It's effectively there or it's not. Okay, you can match up bottoms and tops on a basically on a sloping angle too easily and too subjectively, whereas the horizontal side, like we call that static support and static resistance, is very, very easy to spot, and you can't really make a mess of it, and it's not really subjective. So if in doubt, you can use the volume profile to help you, but realistically, once you've done this for a little bit, it'll be very, very obvious to you. And once you've done that, it turns, you'll almost wonder how you possibly missed it in the past, and you'll start to use it because it's very, very important.
Now, Tyrone, I think I forgot to put the disclaimer on, so I'll just quickly pop that through now, everybody. We do need to put the disclaimer on. So just remember, everything that we're covering here today is general only and educational. So let me just quickly pop that right on. I'm sure we'll get an edit in there a little bit later as well, just to make sure. But look, what a fantastic zone here, Ty, and a very cool idea or concept that we're bringing to even a beginner thing. I think that if you can start to use what might be considered advanced techniques, and I put advanced in like little air quotes because they're not really. What you're looking is support resistance, definitely a fundamental. Lightning bolts, just a simplified version of higher peaks, higher troughs, higher peaks, or lower the other way around. That's really all the basics that we're looking for here. So let's just quickly go back into the slides, then we'll come back to this, and we'll make sure that we cover off what we can. So let's just quickly go through here. So Tyrone mentioned before moving averages. Now, we like to use moving averages totally different to the rest of the market. One of the ways that we like to use it is dynamic support or dynamic resistance. Now, Tyrone on the Tuesday tip, he was looking at it as a potential dynamic resistance, weren't you, Ty? Where it was the market was coming up to the 20 moving average, been a while since it'd been there, been consolidating. High chance it hits that, and at least for the first touch, it was probably going to reject it, which is exactly what it did do. Then we've seen recently it's come back up to it for the second touch. Well, that's a little bit different. That's a little bit different. But here in this example, we have just a 50 SMA. It doesn't matter whether it was a 50, a 20. Doesn't really matter which one. It's a moving average. We like the 20, the 50, and the 200. So you can see the price was being found dynamic support here. So a great little level for us to potentially be looking at. It's almost like drawing its own trend line, yeah, except without us being subjective. So notice this one especially. Look at the price action around here. Bullish candles, similar to what we call a bullish hammer or pin bar, as many people. I would say this is the number one candle pattern that all beginners learn. The bullish pin bar or bullish hammer or whatever you want to call it. Some people have some crazy names for it, and they almost make it their own, Ty. But this is in essence one of the most important styles of candles that we will use from our beginning trade knowledge all the way through to our advanced trade knowledge, wouldn't we?
100%. It's important for so many reasons, but it's also probably one of the easiest candles to understand. And look, let's quickly break it down for you. The open and the close are basically the top of that hammer candle. Okay, so you can see there you've got the open on one side, the close on the right hand side, and the big wick at the bottom is the price action that happened in that candle. Now, it doesn't matter whether that's a 1 minute chart or a 1 month chart. That candle represents the price action that happened between the open and the close and everything in between. Okay, so what we can understand from that candle is that it opened up at a pretty reasonable level. At some point throughout that period, we don't know when exactly, but at some point throughout whatever period that candle is, the sellers absolutely obliterated the buyers and tried to push it completely into the different direction. And at some point again throughout that candle, the buyers completely reversed everything the sellers did and brought it up to close to the open and sometimes higher. That is why it's such a powerful candle, because it's shown a very, very big confrontation between the buyers and the sellers that was ultimately won by the buyers. Now, that candle in isolation in the middle of nowhere means absolutely jack all, nothing. But you put that at a location where you're expecting support, where support is absolutely expected, like a moving average or a static horizontal line, then that becomes one of the most powerful allies you're going to have in the trading technicals, especially when you're setting up for a continuation of a trend. Very, very powerful in the right place.
Yeah, so it's all about the right placement. So let's say we have here a market moving up, or it has already started a trend and it comes back down. And then we see at this point, let's say, actually, we'll use a better example here. It'll lead into the next point that I want to make. So it goes down to this point. And we know this is previous resistance. So it could become current support.
Yep.
There also could be potentially a moving average there. What if there was? What if a 20 moving average was there as well? If we then saw a bullish hammer here, or a pin bar, whatever you want to call it, would this be a stronger trade? We've effectively brought together resistance and support, what we call role reversal. We'll talk about in a second. We've brought in a moving average, maybe dynamic support, dynamic resistance, fantastic. In this case, dynamic support. And we've bought a candle pattern. Now, the advanced technique that we'll just give you anyway, because it doesn't really matter, it's not that advanced, is the idea that you actually, even if you see this candle, what's the normal intention of people to do, Ty? They go buy straight away, yeah?
Yep.
It's amazing how often sometimes even the best plans, you need to have that little bit of a tick above. You want to make sure it continues in that direction. The momentum continues between the close of the candle and the next open. How many times have you seen, let's say, the shooting star or the pin bar rejection or any of them, and then it flows through and it doesn't actually go lower, and then all of a sudden it's back up, destroying the person in the next candle, just because they weren't patient enough to wait. Remember, discipline is the number one thing here.
Yeah. That's a bear trap or a bull trap. And if you ask me my personal opinion on what I would be doing with that hammer with all of those setups, you would have to actually put that disclaimer back on because those setups are worth
Yeah,
their
they're good
weight in
setups.
gold.
Yeah.
They're
Yeah.
worth their weight in gold.
It may seem basic, but that's actually a setup that we will use still
That's
today.
trading
If I see that
101.
on anything, if I
Absolutely.
see that on a currency, if I see that on a stock, if I see that on a commodity in that kind of setup, I'll be on the phone. Ty, I think we need to potentially look at this a little bit further. Let's get into it.
Get that
So that's
disclaimer
always
ready
good.
because it's time to trade.
Get the disclaimer. Disclaimers everywhere. So, look, there are a bunch of basics to do with why we use moving averages. Do you want to just walk us through these, Ty, just really quickly, maybe 1 or 2 minutes?
Sure. Yeah. The simple moving average is just that. It's the most simple form. Basically, all this is doing is working out whatever period you're looking at. So if this is a 10 SMA, 10 simple moving average, all it's going to do is actually add up the previous 10 candles movement and divide them by 10. If this was a 20 moving average, it would be the last 20 candles divided by 10. Okay, if we go to an exponential moving average, which is an EMA, which is actually one of the most commonly used ones, especially for the smaller time frames, that adds more weight to the most recent candle. So you can see here this little graph. You can see how it gets bigger and bigger. That's because there's more weight given to that moving average with the movements of the previous 2, 3, 4 candles. And the further it goes back, the less weight is given. So what that means is that the exponential moving average is going to give you more opportunity to actually have a faster move. They're generally a faster moving average. So you'll see if you overlaid a 20 moving average and a SMA and a 20 EMA on the charts, you're going to see that the EMA is faster because it reacts quicker because it's using the most recent information. It's giving more weight to the upfront candles, which makes it faster. So obviously it's going to move away quicker than the slower moving average. We love the EMAs for the 20 and the 50 for anyone who's wondering. And when we do a 200 EMA that we actually often have on the green, that is a 200 SMA, because when you're looking at the bigger time frame and the bigger SMA, what we're looking for really is an overall view. We're not really interested in weighing up the front end of a 200 candles, no matter what time frame it is. So we always use, these are the ones that are on every single one of our charts. It doesn't matter what we're looking at, doesn't matter what time frame we're on, 20 EMA, 50 EMA, 200 SMA. Our favorite on every single template that we have.
Yep, they're a very big staple. If you were to ask us which one we're going to take, it'll be the 20 all day long, mean reversion, very important to understand and use. So we know these things. Like if I was to pick how I use moving averages, dynamic support, dynamic resistance all day. A lot of people use them as crosses and all these other things. I found that not to be as successful as reading price action. That's my personal opinion. You can use them for crosses. Obviously, it's a technique where they cross above or below each other. But the best way of doing them, I think, is going to be dynamic support, dynamic resistance. So, Ty, look, we've covered a few things here today. Obviously, so far, and I just want to quickly bring this up because I want to go back to the support resistance. We've brought up a concept here where we might have a resistance that is broken, and we don't want to necessarily take the break. You can do that, but a beginner trader might want to be a little bit patient and disciplined. Otherwise, you need to scale in, and that's another advanced concept. But if it comes back down to that previous resistance, it may test it as support. Now, if we at this support level find the lightning bolt, let's say this was a 1 hour chart. We're interested in trading the 15-minute chart because we're scalping, let's say, or day trading. Then if we see this on a 15-minute around this zone, and especially if we see bullish hammer or bullish hammer here, or even a moving average that is respected previously over here, an incredible, powerful strategy. I mean, it's the real deal. I still use it now. Ty still uses it now. Well, this is basic, but powerful stuff.
Absolutely basic and absolutely powerful stuff. Now, we've got a message wondering about these slides. These slides are directly out of our course. So for anybody who's wondering, our technical analysis masterclass, these are all the things that you actually learn in it. So that's where these slides are from. And they do basically teach you all the things that we're talking about here.
So I want to ask everybody right now, obviously if you have questions, please ask them. But I also want to ask you, what are you actually trading right now? What's your favorite go-to at the moment? Is it oil? Is it gold? Is it euro, US dollar? Is it S&P 500? Tell us what you're trading. I'm very interested to see what everybody's involved in right now. Here's an example of obviously resistance, very clean, very easy, becoming support. And what you'll notice over in this point is look at all of these very interesting big wicks. and then all of a sudden it makes a new peak, what do you know? Boom goes the dynamite. Then you get that very, very, very nice large move. So this is a 4 hour, but it could be a 5 minute. It could be a 15 minute. It could be any time frame, really. If you saw this set up, it's a solid concept to get involved in. So I think that that's something that's pretty important out there. And we should always try to understand it whenever possible. So we mentioned before the idea of patterns, Ty. Obviously, there's the inverse head and shoulders, double bottom, ascending triangle flags. You can either do our course or watch some of the other videos we've done on this. I think what I wanted to get through today to everybody was that trading is much, even as a beginner, is about finding multiple different reasons that all make sense to be part of a trade. And that even if you get into pattern analysis, what I'm noticing is too many people, Tyrone, they all go, oh, I've found a double bottom, or I found an inverse head and shoulders, whether they're right or wrong, and the drawing's another thing, and I'm going to take this distance. And what they'll do is they'll ignore the left-hand side where there's this massive support over here, and they'll just say, nope, A equals B. I know that it's going to go this distance, going to this distance, and it stops here and goes off because they get blinded by the perceived vision of that pattern instead of actually looking at what the market's giving them, whether more or less. Very important.
Not checking their profiles. Speaking of patterns and speaking of great times, FX Evolution's having its inaugural conference this weekend. We are so excited. Thomas and I are so excited. It's in Cairns and we cannot wait. But to actually celebrate our conference, we are doing a conference blitz special on the Ultimate Masterclass. So for anybody who is actually interested in doing our TA class, if they haven't actually done it and they want to learn more, I'll pop the link in the chat room window. So just click on that and you'll get 50% off it for basically the next week, because we've got the conference this weekend and it will run through to the end of the conference, just for anyone who's asking.
So a lot of people seem to be here. Odd US dollar, gold, oil, odd yen, some popular pairs here. A few people in on the oil trade, it looks like, Ty, which doesn't surprise me. I mean, everyone's talking about it. I actually had somebody message me. I wouldn't believe it. It was somebody that I've watched on YouTube before, and they messaged me, or they messaged in my comments on one of the videos I did, and they said, of course, something like oil, and they're actually nothing to do with trading at all. And I always think, well, when everybody's involved in something, you always know there's something, there's a lot of volatility set to rise. Hey, Ty. And that's what is happening right now. People that aren't even interested in trading are suddenly interested in oil commodities over the last literal week. Reminds me of GameStop AMC 2.0.
Yep. That's gold and oil are the new AMC.
The new crypto, some people say.
Yeah.
So a lot of people trading odd. Look, there's news, of course, that has come out about this, when we've seen the central bank talking about it, and we've currently got a bit of a bounce. And yes, I mean, we are seeing a turnaround here that's consistent with the market breaching a zone. And if you look back on that day, what you'll notice is it's breached a zone, it's then come back aggressively, and it's finding some kind of buyer demand around this area. So, of course, if you draw that up as a zone of interest, what you're looking for is, in essence, some form of lightning bolt. So you're looking for something like what you've seen here on the smaller timeframes when it breached through there. Actually, not a bad trade. Or if you're looking at the bigger timeframes, something like that as well could be very good. So, yes, it's exactly the right area. And that actually was a decent candle trade.
Yeah, they're everywhere when you look for them, and that's the difference between beginners and advanced in our rooms. Like I say, people who become good at it will start to spot them very, very quickly, and certainly a lot more frequently. But believe you me, they trade the same way, and that's what we love about trading. You don't have to be a rocket scientist. I don't even think it'll help you to be a rocket scientist. I think it'll actually be a distraction.
IQ is not relevant when it comes to trading or investing. In fact, the higher IQ you have, the more likely you actually are going to be pretty bad. Yeah, because you can't simplify things. Somebody again messaged me, Ty. They said, my friends are like geniuses, but they have so much information in front of them. They have absolutely no idea what's going on. They confuse themselves.
Yeah, I'd like to
I'm not the
actually
smartest
add.
person, neither are you,
Yeah.
but we do probably better than they do.
Now, I think sometimes people need to, look at, if you're looking at describing words in a dictionary, genius should also have know all next to it, because that's the problem with a lot of them. To be honest.
Well, maybe that is true. Maybe that is true. Look, well, we had some questions here. I think most of them have been answered by a few other people.
Mm.
What's the other question I guess we had, which was about opens? How do you like trading those? Well, actually, we look for lightning bolts. We look for breakouts and retests of the session trend. And if I was going to leave a beginner with something, I would say if you're looking at currencies, and let's say you're trading the London Open, if you took the Asian session, let's say there was some trade during the Asian session and it was looking like that, and you wait for potentially the market to either open, and maybe if it broke a level and then did something like this, when it broke past the Asian trade period, so the Asian high, and it did suddenly a reversal and then follow through, that could be a fantastic trade towards the short. Or conversely to that, if you had a market that was like this during the open, remember high liquidity, and it breaks through and retests and then does something like that in a small time frame, session high, session low from the previous session, could also be a pretty cool level to look at. So certainly some interesting stuff that can go on there. Mick Curris says, fib retracement and fib extensions on odd US dollar have got me more wins than losses. Patience required. Yeah, fib is great. We like Fibonacci. And fib extensions, if you ever wanted to draw one of those, basically you're just drawing it backwards like this, and you're looking for these types of extensions, 1618, 2618, etc. A bit more of an advanced technique, I guess. But fib is something that you could bring into your trading later on. Absolutely. We love fib. Very good.
Brilliant.
All right. Well, I guess that probably brings us to the end. So we'd just like to say thank you so much for obviously Pepperstone for hosting this. We hope that you all enjoy it. If you do, please give us a like button. We had quite a few hundred people here going through this with us. So if you enjoy this type of content, let Pepperstone know. Today was a bit more beginner. It was really to try to get you, even advanced intermediate people will get something out of it though. It's to get you in this mindset that we are all about price action. We're all about the psychology of the market. And that's what you want to start with, that solid base of that kind of thing.
100%. And if you're not already a subscriber of the Pepperstone channel, be sure to make sure you jump on, subscribe, so you get all of these videos. You'll be able to basically get alerts of when they're coming out and all of the good things that Pepperstone do. We've got a big library of all of our material and a lot of other material. Pepperstone have got a lot of contributors and a lot of very clever people putting out a lot of content. So be sure to hit the subscribe button and check out all of the content and go through the library for the backlog, because you will not be disappointed.
Well, from all of us here at Pepperstone, thank you so much for joining us, and we'll leave you with the outro. Bye for now.